So you guys have probably seen this a couple times. But what it basically says is this is risky, and it does involve a significant amount of leverage, which is a double-edged sword, as hopefully we know by now, and which can amplify your losses just as well as gains. And so if you're just starting out, or if you have any qualms about whether this is right for you, certainly consult an independent advisor. Think about it. Make sure you only trade risk capital. Make sure you only trade capital that you can actually afford to lose. Okay? So, FX correlations. First thing that we're going to do here is we're going to talk about the basics of correlation, sort of what is a correlation, what that means, and most importantly, what it doesn't mean. Because a lot of people tend to make assumptions about whether a correlation necessarily means that something causes something or not. And it doesn't necessarily. So we'll talk about that. We'll talk about the most important relationships that we find in the markets now, and hopefully dispel some of the myths about some of the relationships that are believed to be there, but maybe aren't necessarily as strong as some people think. And then we're going to talk about, if these things are correlated, why would you trade FX and not what it's correlated to? So what are the advantages of actually choosing FX rather than the asset? And we'll certainly talk about some common pitfalls. So, just to get started, what is correlation? First and foremost, simple definition. It measures the degree to which one variable, or basically one asset, moves in line with some different asset. It's expressed as a correlation coefficient, which is basically just a value that ranges between -1 and 1. Obviously, +1 would imply that those assets move perfectly in line with each other. -1 would mean they move perfectly in opposite directions. Right? So, pretty basic. Now, the absolutely most profound correlation that is found in the markets today is the correlation between the Canadian and the Australian dollars and the S&P 500. Notice I didn't say gold, but the S&P 500. So let's think about this logically. Why does that exist? What is the S&P 500? Sort of big picture. If you think about it, the S&P 500 is just a real-time indicator of what investors think the earnings of the world's largest companies will be. If they think those earnings are going to grow, they're going to buy stocks. If they think they're not going to grow, they're not going to buy stocks. They may even sell stocks short. Now, considering this is an index of the world's leading companies, it's intimately a function of global growth, because obviously most of these companies are, in today's globalized world, going to do business everywhere. They're going to have affiliates everywhere. And so that outlook on earnings is going to be very much a function of what people expect big picture overall growth to look like. Now, as you can see, then, the S&P is just a real-time indicator of what investors think growth will be in 6 months, 12 months. Now, what are the Aussie and what is the loonie? Loonie, of course, being the Canadian dollar, Aussie being the Australian dollar. They are both commodity suppliers, and both of them consider as their leading clients two of the largest economies in the world, US and China. Now, if growth in the US and China represents the two biggest drivers of global expansion as a whole, then the demand from those two countries is going to basically mirror global growth in general. Because without demand from those two places, there is no global growth. And so, if you are Australia and your number one export is iron ore, and you're digging up half of Australia, you're taking that iron ore, and you're selling it to China, okay? And China is the world's largest buyer of iron ore, because that's what they use to smelt steel and build all those shiny new cities. So if you are Australia, and all of a sudden China slows, guess what? Nobody's buying iron ore. So what does that mean for your economy? That means your miners aren't making money. They're probably not hiring. In fact, they're probably scaling down. If they're scaling down, that impacts wages. That impacts, of course, consumption, because if you were a miner, your Chinese demand went away, all of a sudden, maybe you got laid off. Maybe your disposable income went down. Maybe you're working fewer hours. You're not consuming as much. Australia, as an economy, begins to slow. That impacts directly the outlook on rates, and that impacts directly the Australian dollar. But when you get out of those specifics back to the big picture, where did all of this start? With Chinese demand, which is an integral part of global demand. And so the Australian dollar then is no less a reflection of global growth than the S&P. It's essentially the same theme. It's the same exact picture. Now, if you want to swap out Canada for Australia, swap up the US for China, and swap iron ore for oil and lumber, you get exactly the same dynamic. If global growth depends on US demand, and parallel to that, Canada basically lives on US demand, considering 80% of everything they sell overseas is coming here, the theme that is going to be moving the Canadian dollar is going to be that same global growth theme that is moving the Aussie and that is moving the S&P. Okay? That is a chart of the two correlations. Okay? The red one is the correlation between the Aussie and the S&P. The blue one is the correlation between the Canadian dollar and the S&P. And as you can see, on average, since about a year ago, it's at about 0.7. Not perfect, because perfect correlations generally don't exist, but pretty close. Now, of course, the natural question is, what in the world happened right there? Where did that correlation go? That black line that I've superimposed over the chart is an index of U.S. economic data surprises. Something that Citibank will put together that essentially just says, okay, if U.S. data surprises better, index goes up. If U.S. data surprises worse, index goes down. Okay? So what you'll see is, right as the correlation starts to weaken, U.S. economic data surprises peak, which means that the U.S. dollar here is not being driven by these bigger global growth themes. It's being driven by, oh, well, maybe the Fed will finally raise rates. Maybe the data is getting so good, maybe the recovery is picking up steam. And that's why it's so important to monitor these correlations. You can't take them as a given. They will change and they will shift over time. But of course, as those expectations fall off, the correlation comes right back. Now, the next relationship I want to take a little bit of time with because it's a little bit complicated. And it's the relationship between the yen and U.S. bond yields. Now, why might that relationship exist? We know that the U.S. is Japan's very narrowly second largest export market. For many, many years, it was the first number one export market, then China got big. And so now the U.S. is Japan's second largest export partner, but by a very narrow margin. We know that Japan sells a lot more to us than we sell to Japan. And so if you sort of visualize that, there is a surplus of goods that comes from Japan to us, and so then there is a surplus of dollars flowing from us to Japan, right? And so Japan is then left with essentially a pile of dollars. Now, for Japan, the question is, well, what do you do with all those dollars? Right? Now, you basically have two options. Option one, you keep the dollars, you buy assets denominated in dollars. U.S. stocks, U.S. bonds, real estate in Manhattan, what have you. Option two, you convert those dollars back to yen and you spend them at home. So how do you decide as Japan? Do you keep the dollars or do you convert the dollars? You look at yields. Because what is the government yield? It is the benchmark rate of return. It is the safest, relatively speaking, return that can be had, because chances are, if you lend money to a government, it's a lot likelier to pay it back than John on the street, or even a corporation, because a government can always tax. And so chances are, if you lend to a government, it's relatively safer than lending to something that can't tax, or lending to something that is more likely not to be here tomorrow or the day after. Okay? So that is why people always say, oh, well, government bonds are quote-unquote risk-free. Well, nothing is risk-free, but it is as risk-free as it gets. And so you look at, then, the difference in the benchmark return on U.S. assets versus Japanese assets. And obviously, as any rational person would do, you pick the one that yields more and you put your money there. So if you're Japan and you yield more than the U.S., that's where you go. If you are Japan and you see that rates in the U.S. are better, maybe you keep that surplus in dollars. Now, we know that Japan's interest rates have been at or near zero for a couple of decades now. And we know that the Bank of Japan goes out of its way to tell us that they're not going anyplace else. If anything, they're going to find ways to make borrowing in yen even cheaper, as cheap as is possible. So that difference between yields in the US and yields in Japan are basically just going to be US yields because Japan is 0. If you look at the difference between a number and 0, you're literally just looking at that first number. Okay? And so this decision on the part of Japan, whether to keep their trade surplus in dollars or to move it into yen, considering yen is at 0 in terms of yield, is going to be directly influenced by where US borrowing costs are going. And so dollar-yen then, which is that exchange rate, is going to mirror that underlying flow of capital. And is going to reflect, essentially, Japan's preference to either keep their money in dollars or to exchange them into yen. And that's going to be directly a reflection of how attractive US yields look. The more attractive, the higher dollar-yen. And that's why when US interest rates go up, dollar-yen goes up. And when they don't, as we know, they've been very, very low, record lows for a very long time now, for several years, dollar-yen sinks, and sinks, and sinks, and sinks. And there is the correlation there. So again, for the past year or so, it's averaged 0.7. And of course, again, the question becomes, well, what happened right there? And at this point, you'll recognize this chart. Exactly the same thing. Right? The US dollar started moving away from being influenced by big picture trends, and people started paying a lot more attention to the sudden and unexpected improvement in US data towards the end of last year. I should also mention, towards the end of the calendar year in general, things get a little iffy. You guys have probably noticed this. And that is simply because beneath all of these markets are people. Just a very large collection of people. And in December, people like to go on vacation. And when they go on vacation, liquidity in markets will get significantly thinner. And markets will start doing things that don't make sense. Because the vast majority of the larger players are celebrating the holidays. And when you come back on January 2nd, all of a sudden, things begin to move very rapidly. And by the middle end of January, all of a sudden, things start to make sense again. People came back to work. You'll notice that's happening, that divergence there, exactly towards late January, or late December, early January. Keep in mind, markets are forward-looking. They're not trading on what's happening now. They're trading on what they expect to happen in the future. Okay? I want to talk about why you wouldn't just trade bonds. Why you wouldn't just trade the S&P. Why would you want to trade these moves through FX? And the first thing is FX is, of course, incredibly liquid. And what you see here is the average daily volume of the S&P, which is, again, the world's largest stock index. So if you take a look at any other stock index, it will be lower. Back about 10 years or so. And you'll see that on average, the S&P does about 6.2 billion in volume a day. So 6.2 billion change hands daily. Okay? Sounds big. That's FX. That's from the Bank of International Settlements. Okay? Foreign exchange overall in 2010, 3.9 trillion changing hands a day. Just spot, 1.5 trillion. As you can see, it is slightly larger by a very narrow margin. The second, of course, is rollover interest. Okay? Now, of course, I think at this point you guys probably know currencies are yield bearing. They are, of course, tied to the interest rate of whatever central bank is in charge of that currency. And so by holding currencies that yield more against currencies that yield less, you can earn that yield differential. Now, the most common question I get from die-hard stock traders is, well, we get dividends. Why is that not as good as your rollover? It's just as good. It's the same thing. So I decided to study that. And what I did was I took the average dividend yield on the S&P going all the way back to 1991. And I took the return on Aussie dollar, just the yield, not the price, just the rollover yield. And I subtracted one from the other just to see, who would yield better if I bought Aussie dollar or if I bought the S&P 500 in 1991 and just held. And on average, obviously you can see that there's periods there when it goes negative. So if the difference goes negative, that means the S&P dividend yield was greater. But on average, you earn about 2% more a year in rolls on Aussie dollar than you would in dividend yield from the S&P. Now, of course, that doesn't mean you're going to earn 2% every single year. But what do most stock investors do? You buy and hold. So if you were a typical stock investor and you were planning to hold something for 10 years, that average would start to make sense. Because over a 10-year period, that average would start to kind of kick in. And so it would start to make sense to say, you know what? If the S&P and the Aussie dollar are that correlated, and if on average the Aussie dollar roll, again, historically, and as we know, past performance, not indicative of future results, because if China decides to clamp down on their economy, all of a sudden Australia loses that mining demand, that relationship might go away. But historically, it makes sense if that correlation is holding to say, you know what, I'm just going to go long Aussie dollar and just hold it. Of course, that implies using almost no leverage the way you would in stocks. But that is a distinct advantage. Now, I want to talk about some common pitfalls that people email me about at least daily, usually several times a day. First of all, correlation does not imply causation. There is nothing I hear more often. Gold is correlated to the Swiss franc, so if gold goes up, that should mean the Swiss franc is going to get pulled higher, or the other way around. And of course, that does not hold true whatsoever. There is absolutely nothing about the Swiss franc going higher that would cause gold to go higher. They might go higher together because they are both responding to the same theme broadly in the market. And then they would be correlated because they are both responding to the same big picture story. But that doesn't mean one is causing the other. That's very important because many, many times I will get clients that ask me, you know, you keep talking about this stock and this Aussie dollar thing. Well, stocks went up. That means the Aussie dollar is going up. Maybe. But one is certainly not causing the other. So definitely pay attention to that. Which brings me to the next point. Unrealistic expectations, right? If you guys notice, none of these correlations had a value of 1, which would be perfect correlation. None of them had a value of -1, which would be perfect inverse correlation. That is because those kinds of correlations generally do not exist, as a rule. They can get close. I've seen Aussie dollar and the S&P, if I recall, get to something like 95, which if you round off is kind of close. But almost never are things perfect, and so if they are not perfect, then you can't expect these instruments to move tick for tick exactly the same. This describes general trends. It doesn't describe what's going to happen on a 5-minute Aussie dollar chart versus a 5-minute S&P chart. So don't expect that. Okay? Look at them as relationships that are strong, relationships that will hold, but not relationships that you can bet on to scalp with. Okay? And that speaks directly to the next biggest pitfall, which is a lack of flexibility. Just because something is correlated now does not mean it's going to be correlated tomorrow. Like I said, if, for example, China, which has a very high inflation rate, which is something that they're preoccupied with, trying to get down, if they clamp down on economic growth to fight that inflation so hard that Australia meaningfully loses that demand, the Australian dollar is not going to be as good of a proxy for global growth because China will not be as big a piece of that pie. And that correlation can go away and then come back or not. And that's why it's very, very important to monitor these things regularly. And to help you do that, I write an article every single week that's called the Fundamental Trends Monitor, where I will go through what the key relationships are for every major currency. Usually comes out Sunday night, Monday morning. So Monday morning Asia, Sunday night California. Okay? And if you want to subscribe to it, it's easy. Just shoot me an email. I'll put you on my general email list and it'll just show up when I put it out. Okay? Now, we are unfortunately out of time, but that doesn't mean you guys can't ask me questions after I get off this podium. Thank you. Thank you. Thank you.